Well, just like that, we're back to a bullish posture again. So, but we're not. It's not a strong bullish posture, mind you. So, I'm going to break down what this little bounce means. Have we formed the bottom? Are we out of the woods? We talked about the potential for a support bounce this week in Friday's video. We're seeing that start to play out. Again today, we're going to break down the charts and see what it's going to look like now heading into the end of the week and where there's some opportunity for some bullish trades now that things are turning back around again. So let's go ahead and get started. Today is Monday, February the 12th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for watching tonight. Welcome to those that are watching for the first time. Glad to have you. Glad you found us. Keep coming back every day for more. Subscribe to my YouTube channel by clicking that red subscribe button right down below the video there. You can do that right now while you're watching. Also, while you're down there, hit the thumbs up icon. That lets me know that, number one, that you liked the video today. You got something out of it. And number two, it lets me know that you want me to do it again tomorrow. So one click, very easy way to give me feedback. Let me know what you think. Comment on anything that stands out to you from today's video down below. You have to scroll down even further. And then join my daily email list, newsletter that I send out, or my daily email list, Market Outlook email. I send out every day time-stamped hyperlink summaries of everything we talked about in these videos. So sign up for that. Also, remember to follow me on Twitter. My handle's up on the screen here at DavidSettle42 to get more content like this throughout the day. Remember to like and retweet tonight's Market Outlook tweet there. And then join the Market Outlook community on Facebook. We have a Facebook group. There's an address at the top. There's also a link down below in the description that you can click. It will take you there where you can join. All right, well, let's take a look at the S&P 500 with the market forecast indicator. You can see short-term sentiment's improving, not surprising because we've rallied now, and we've rallied sharply off of Friday's low point. That continued today. We closed above Friday's high point, so that's a good sign. When you're looking at pullbacks, and this was indeed a pullback here, well below, in fact, got down to the 161st retracement level of the near-term rally, that really long near-term rally, way longer than it should have been, because again we only expect 7 to 10 days, and that was like 20 some odd days. So very long near-term rally. We pulled back and went past the previous near-term low point. In fact, went past multiple previous near-term low points until we got to that semi-area of congestion there. In which case happened to be about the 38% fib level and also that 162% level. So close above the high of the low day is what you call that. So when you have a pullback, in this case an intermediate pullback, because it brought the intermediate line down below 50. So when you have an intermediate pullback and you close above that high point, so you can look at some of these here and you can say, okay, here's some low points here. We close up above that. Try to get started again on the near term, but close back down on 817. There's your low point, lowest low during this pullback. Close above that, and then you go kind of hung around. You can see using that for support, filling in the range. Morning star candlestick pattern here with 2 days in between instead of just one. And then that was it. That was a rally. We continued higher. We bounced up, formed a higher near-term low point right afterwards, bounced up to a new higher high, and the trend got started. So that's what we're going to look for now. Is the next near-term high point is not going to be most likely won't be a higher high point. I mean this one here got in fact it never did. It got to 49, didn't it? So that's technically we can delete that one for some reason. Maybe it was on SPY that it got above 50. So that one came close. You can see it got the 49.65, but did not quite get up above the 50th percentile. So this is all really one big, but that bullish diversion is still intact and still puts 2,700 as a target for this near-term bounce. But again, I'm not expecting a near-term high to get above that, not even close, the next near-term high point. And then look for a pullback, probably hitting 2,700 based on the divergence, and then hitting that for resistance as you would expect it to, because we always expect support and resistance to hold until it doesn't. Hit that for resistance, pull back from a higher near-term low point, and now the trend started. It's a bullish posture right now, but it's about as weak of a bullish posture as you can possibly get. It's, the Patriots have the ball, they're backed up against their end zone, and who knows that there could be a strip, sack, fumble, and the game will be over, right? Don't want to take that analogy too far, but the idea being that that's about as weak of a bullish posture as you can possibly get, because it's backed up against its own end zone. It's backed up against the 20th percentile. It has to get above 50 to start the 1 to 3 month expected time frame. And again, probably closer to 1 month, because market sentiment's dropping, number one. And number two, even if it were to bounce, it would be bouncing up from a pretty darn high point. It would be higher than the last one that we bounced up from. And we were only expecting one, maybe 1.5 to 2 months there. And by the time market sentiment crossed back above 80, we were already a month and a half in, and then we just got this explosion from the tax reform bill. See, right here we started to run out of gas. It was kind of holding on for that tax reform news to come out. It started to come out, and then whammo, that's what happened. And of course, we corrected all of that in this one near-term pullback, one big old near-term pullback. So that's kind of the expectations going forward. You can see most of the major indexes look very similar. They're all going to be bouncing right now. That's, everything's bouncing up. Remember, correlations at the beginning of bullish moves are high. At the end of bullish moves are really low, because different sectors take their turns leading us higher. But at the beginning of bullish moves, everything goes up. So you can see the Dow Jones Industrial Average rallying higher, the NASDAQ showing a bullish posture with improved short-term sentiment, closed above the high of the low day. Russell 2000, same thing. Close above the high of the low day, intermediate line getting out of the reversal zone, weak bullish posture, falling market sentiment, but still at very high levels. So that's why, again, I'm not expecting this to be like, okay, now we're going to start this multi-month intermediate run. No, there's going to be some volatility here, as is typical for this time of year as we head into spring. I still think that there's a good chance we get a bullish move for the rest of the year. And remember, I posted on Twitter here some data points about these pullbacks and what they can lead to from here, as well as from LPL Research. So check those things out. Those were some kind of gives us the expectations that 2018 still can be, despite this crazy move, still can be a pretty decent bullish year, and that's the expectation still. We just got that 10% correction that we typically get. Anyways, we just got it really quickly. In fact, the quickest, the fastest that we've ever gotten it from an all-time high. While we're here, I did want to remind you to like and retweet the Market Outlook tweets, always pinned up to the top. I scrolled down to Wednesdays. Wednesday, we hit a new record on likes. We had 142 likes. It's awesome. I really appreciate that. We're trying to get to that 150 mark. We came really close. Dropped off a little bit over the weekend, but let's see tonight if we can't get this back up over 150 for the first time ever. And remember, the benefit you get out of doing it is the more you engage with my tweets, the more you like and retweet, the more Twitter will keep pushing you all my tweets. Make sure you're getting them because they see that you engage with them. And then what I get out of it is the more you engage with these tweets, the more Twitter will keep pushing it to all of my followers because they see, man, this is a pretty engaging piece of content. In fact, if you look at because of you, the impressions were really high for that one tweet. 17,000 impressions. I only have 4,000 followers. So that Twitter will keep pushing it out to all of my followers, as well as other people that follow you, and even if you don't have followers, to other people that follow this type of content because they see it's a highly engaging piece of content. When you look at the long-term chart, you can see we are kind of stuck in this zone between the 250-day moving averages. You can see when you're stuck in that zone, we typically get back up above the 50. And who knows how long it will take. You see all these other times where we didn't quite get below the 200 here, we did. But all these other times we didn't quite get below the 200-day moving average, we get right back above. And we also talked about, too, that we typically don't get that strong, sustained move below the 200-day moving average until we've gotten a lot of arrows, which means a lot of testing the 50-day moving average more than just once every few months on average, which is basically what we've had. So we'll get back above, get another green arrow, and then, again, like I said before, I don't think... we won't get to new all-time highs in the current run, and we probably will by the end of the year, kind of something like this, grinding our way higher to a decent gain for the year is what I expect. But along the way, there will be more volatility, which means there will be more arrows on this chart. This is just the start of it. But considering that we're stuck in the range of a pretty wide MACD, you know, the past precedent is to get right back above the 50-day moving average on the next run. And you look at the 3 green arrows. Again, of course, you've got the close above the high of low day, but you notice we're also still below the 8-day moving average. So, I mean, that's a sharp move. The MACD is just now turning up higher. I've shown you before in Friday's video, you know, what happens when we get this low on the MACD and what to expect. And you can see the stochastics has crossed above its moving average. So, you know, still, you've got these bearish moves, and we're not as bearish now. We're not that strongly bullish either, of course, but we're not that bearish anymore. So, you know, don't expect big moves to the downside anymore, because we've kind of halted that downward momentum. Doesn't mean that we can't fill in this range, right? You can always fill in the range of that long lower shadow on the weekly chart. I mean, this range is always in play, but not. I don't expect that we'll break through those low points and sustain a move below the 200-day moving average. Not like anything can happen, and not like it can't happen, because as we just saw, anything can happen. This move was the fastest move we've ever gotten from all-time highs, but we wouldn't expect. You can't expect the unexpected to happen. You can plan for it with stop orders. That's what stop orders are for. Stop orders are for those unexpected moves. Right? Because if we knew if things always worked out as expected, then you could just buy low and sell high, right? As expected. But sometimes things don't go as expected, and you get the unexpected. You know, you buy off support, but stocks bounce off support, they bounce off resistance. That's the expected. They trend higher. You bounce off higher low points, you go up to higher high points. That's the expected, right? It's those times where stocks do the unexpected that you have to protect yourself, and that's what stop orders are for. And position sizing is to help you when we get this kind of move, this unexpected move. And now we start to move higher. You still can't say, okay, well, one thing happened that was unexpected and now everything is out the window. No, we still have to go with what we got, right? Historical price patterns can give us expectations going forward, and we plan for the unexpected. We protect against the unexpected with proper risk management, position sizing, and stop orders. The intraday chart showed a higher high and a much higher low point than we had, closing up above Friday's high. So there's a close above the high of the low day, closing towards the upper end of today's high. You know, we gapped up, filled in the gap right off the bat. That happens a lot, and then we hit that low point, higher low point, bounced off, and went through the opening high and came back down and used that for support, 265, a couple of times, including right at the end of the day. You can see that the range today dropped back down about in half, more than half, about to over 5 points there. Filled in the gap, so we can include that. You can see the volume dropped down considerably, so huge amounts of volume last week, dropping down considerably down below 141 million. If you take a look at the 4-week range here really quick, you remember the 4-week range is really wide right now, over 30 points with a gap in between, right about where that high is. So there's going to be some. That's the high point that we're looking at for the near-term divergence on the S&P 500. So once you get up to there's going to be multiple areas. In fact, you could probably even, well, you would have a 50% Fibonacci retracement roughly in that area, around 270 to 271. You can see those Fibonacci of this pullback. So there's going to be a lot of resistance in this area. So that's why I think we'll hit up in here, if not already, but maybe even continue up a little bit higher, hit up in there, come down, form a higher near-term low point than 255. How much further down we'll go? You know, there's a lot of volatility still. You can see the trading range, the volume is just a little bit below average, but that average is as high as it's been in a long time. In fact, I kind of have to go back out a little bit for 5 years to get to as high an average volume. Early 2016 is the last time we've had that high of an average. The trading range has been the highest it's been in 4 years, in 5 years, and today's range is higher than that average. So once we start getting, you're going to get some 5-6 point moves. There's going to be some volume here in this area as we fill in and trade around this lower half of this 4-week range. Once you break through that 270, then okay, we're out of it now, and you know, any new low point we'll get will be higher than this one, and we'll just start to trend again throughout 2018. Again, I'm expecting, you know, something, you know, we've had low volatility here, and you can really see it here, very low volatility, and now we're just going to get more volatility, but doesn't necessarily mean that we can't end the year higher than where we ended 2017. Volatility is still high on an absolute basis. Here's the VIX, you know, coming down from this double top, and again, there's some support here, and I would not be surprised if we don't bounce up and get around here, this high 20s to 30 area before rolling back over. And it takes a while and multiple months, but you know, what we've seen in the past is when we've gotten to the 30s and the 40s, we grind our way down, back down. This is usually spikes in volatility, usually one expiration cycle spike that we get. In this case, from January expiration to February expiration, and then it's a grind back down over the multiple expirations after that. But while it's high, and you can see here it's still high, it's still above 1, so it's still, you know, it's not as extreme. 1.15 is the extreme level, so it's not as extreme, but it's still high, it's still easily above 1, and while it is high, we're going to get big moves up and down. We just want to see that near-term trend establish itself to the upside and lead us up off of a new intermediate low point. All right, when we take a look at what's driving this price action, you can see how emerging markets, crude oil started the day strong in emerging markets. They were the biggest winners before the correction. They pulled back the most during the correction, and then they started the day strong, pulled back, bounced up. Crude oil didn't bounce as much. In fact, finished today with only a small gain as it pulled back late in the day and kind of diverged away from all these other equities. You can see that small cap started the day negative. In fact, pretty down 0.8%. During this pullback that left the large cap index up 0.4%. Off that low point, different story. It bounced off of its low point, but because it started the day weaker, and really if you go to this from the low point that stocks have had here, from right there we go. Small caps have been lagging behind, and that gap widened early this morning. Shrunk a little bit in the afternoon, but you can see small caps, developed markets underperforming emerging markets. That's not surprising, but the fact that small caps is underperforming large caps kind of is a little surprising. That you like to see risk asset classes doing better than the quote-unquote safer haven asset classes. And you can see crude oil pulling back today, not bouncing as much, and you can see the treasuries are really underperforming high yield. And if I go back all the way back to when the pullback started, this correction started, so back to the 29th, if you take a look here, corporate bonds are they're only down 2%. High yield or treasury bonds are down 4%, long-term treasury bonds. So that's a positive sign that shows that this was really all a big equity move, equity market move, and in my opinion was all technical based. We were so far up above moving averages. We talked about we were walking a tightrope at very, very high levels. Don't want to use the analogy I used to use before, but it's like you're walking a tightrope above the Niagara Falls, right? Any little thing, the higher the tightrope gets, the bigger the fall is, and so I think this was all just purely technical driven, and you can see from the intermarket relationship that was the case too. Gold is down 2% with the dollar rallying today. If I were to look at just today, the dollar was it was the biggest winner during the correction, but it's on a downward trend itself. So it's recovered back to that downward trend. You can see gold bouncing back up, long-term bonds bouncing up as well. They're starting to rally up a little bit. And you can see crude oil bouncing before, like I said, pulling back late in the day. So your typical kind of risk-on move, except for the fact that for a couple of things, small caps underpacing large caps, and crude oil by the end of the day underperforming, gold. Those are two things that you don't expect in a good risk-on move. So what that tells us is, yeah, we're bullish. We're not getting up to new all-time highs anytime soon. Yes, this was the fastest correction to 10% move from all-time highs. I don't think we'll get that fast of a move back up. I don't think we're going to new lows either, but I think the process of getting back up and getting a decent return by the end of the year is going to be a more volatile process. Which doesn't necessarily mean that we're going to tank. It just means that there will be more ups and downs than what we're used to in 2017, and more like what we had seen before 2017. 2017 kind of gave us this false sense of, oh, well, we never get volatility, and we'll just kind of grind our way higher. That's not the case. In 2018 so far is showing that. If we take a look at the calendar here, there's not much on the calendar that came out today. It's really a quiet Monday. It'll be a quiet Tuesday tomorrow. Later in the week, we'll start the round of economic indicators. It usually starts with the Empire State Manufacturing and the PPI, or CPI, excuse me, will come out on Wednesday. Those inflation data points, you got retail sales as well. So it'll be quiet tomorrow again. So think, again, more of a technical driven, probably more of a bounce off this oversold level, potentially up to that high on the S&P that we're looking for with the divergence before economic indicators start to influence the price action. Remember, the economic indicators are pulling down, not as good as they have been versus expectations, but it's still doing very well compared to previous years at current levels. And then you can see economic rate hike expectations are dropping. March is still widely expected to be a rate hike. You can see for March here, the odds of a rate hike are still very, very high. So getting one more, that will get us to 150.75, 150 to 175. Then you notice the odds of staying to 150, 175 are now back almost up higher than another rate hike by June. So we'll keep an eye on those trends because that can impact equity sentiment. Again, won't necessarily push us up to new highs. I actually think more rate hikes will push us up to new highs because it will show that the economy is strong enough to sustain them. I think if we don't get these rate hikes, if we continue lower and we get, they kind of halt after March, or maybe not even do March, then I think that will actually be more bearish for the markets because it will show how weak footing it is on. These high valuations that we have currently are unsustainable. All right, so now let's take a look at the sector rotation, and just looking again at today only, and from the recovery, again, energy, crude oil, and emerging markets started off strong, right? So energy stocks started off strong, materials with the dollar falling back down. Technology has been leading this bounce off of Friday's low point, along with consumer discretionary, consumer stocks in general. Real estate with bonds performing as they did, you can see real estate and utilities lagging. But from that low point to the end of the day here, real estate and utilities actually did pretty well. They kind of matched the market up. Consumer staples lagging a little bit, and energy stocks, remember, crude oil lagged during the afternoon, and so did energy stocks. So just a reminder here that when we're coming up off of lows, that typically the correlations are closer to 100% down and back up. And then as we continue to move up, the correlations start coming back down to zero again. You can see technology and energy, materials, industrials, consumer discretionary, all off of the lows, all matching the market or doing better. Financials lagging a little bit, with the yields kind of slowing their climb. Healthcare lagging, as well as other safe haven areas. Still up, but lagging behind the broad market as a whole. All right, so for today's trade idea, we'll stick in this technology area that we've been looking at for the last few trades. This one being Adobe, and you see Adobe bouncing off of, coming off of long lower shadows itself, not coming anywhere close to its last intermediate low point here. It does have earnings coming up. It's on March 15th. We have earnings there. You see its intermediate line didn't come down below 50, and it's turning up a little bit. The short-term sentiment coming up off of these extreme lows for the momentum line. And again, same divergence on the near-term line with this near-term low being a bullish near-term low point, so not getting as low, not getting into the reversal zone. You can take a look too at its 3 green arrow chart, and you see MACD and Stochastic is giving you a phantom green arrow, which is bullish. A green arrow on the moving average again, and we were below it a little bit. Now we're back up above it. Those lines have converged. The MACD has gotten down towards zero, gotten a little bit below zero actually, starting to turn up a little bit. Closing today above the high below day. So you can see that there's some support in this area. If you look about right in this 160, 186 area, you can see on a closing basis, well, maybe 185 to 186. On a closing basis, there's just some support there. And of course, you have some intraday moves below that down to 180. But from a closing level, pretty decent support coming up off of that. Now trying to get back up above. In fact, it's above the 6-week moving average. And again, like I said, closing above the high of the low day. So, and again, we're not in the, we're in a weak bullish posture. So we're not in the environment that we want to take on a lot of bullish risks yet. But here's an opportunity where we can say, okay, well, how about we sell the 185 because volatility is really high for these options here. We'll sell that the March, right, the day after earnings, in fact, is the expiration. We'll sell that 185 and buy the 180. And what that gives us a pretty decent odds of success, pretty decent credit too. Now, it's a wide spread, so you have to manage the credit. So what you do is you just kind of maneuver this around until you get filled in. So you do your position sizing, figure out how many contracts to do, and then work with one contract to see where the market's at. Right? The platform right now says the market's at 135. If you did a market order, you'd get 95 cents. So you obviously you want more than 95 cents. And the platform says the market's at 135. That's probably being pretty aggressive. So you have to kind of fiddle around with these prices here until you get filled in. You don't want to get filled in too quick, but if you put it in, and after a minute or two, or 5 minutes, whatever. Again, if you get filled in immediately, then that means you're below the market, right? Because they're glad to give it to you immediately if you're below the market. So you kind of let it sit for a little bit, permeate, right? Marinate. And then you get filled in, okay, that the market's willing to be in that spot. And again, you want to wait until the first hour, the market's moving a lot. Stocks are moving a lot. So you want to let things settle down a little bit. And then you just put that trade in. And if it fills, great. Eventually, if it doesn't, then you just kind of continue to move the market lower until you do get filled in. And once you do get filled in, then you can set up the rest of your order with the rest of your position based off your position sizing, because now you know where the market's at for that particular trade. So that's how you can get filled in there. You can see pretty decent odds. And when you look at the where the stop order is, so there's the stop, there's where your break even is on the trade. You notice it's below the Bollinger Band. We're coming up off of that lower Bollinger Band. There's some support we talked about. And also you can see, again, if we were to break that 185 level and even just get down to 182, we lose about $100, a little bit more than $100, which is about what we're trying to make. So I can get a decent 1-to-1. And here's the situation again, because of earnings that's coming up the day before, we probably won't go for the full maximum gain on this. In this case, we'll probably go for, like 50% of that or 75% to try to increase our odds of success. Get that credit in as soon as we get it. And then just close out the trade and take away the risk of that earnings announcement that's literally the day before. So that being said, that's what we got for today. The market is bouncing. Again, don't expect it to bounce nearly as fast as it dropped. Don't expect it to bounce on this current run up to new highs. I do think eventually we will get new all-time highs by the end of the year, but it won't be this month most likely. So of course anything can happen, right? But that's not what I'm expecting based on what I've seen in the past and how deep this particular move has been. So that being said, there's still a lot of opportunity here. We talked about Friday, how getting stopped out on previous trades allows us to take advantage of this opportunity. So we'll look for those like the one we did for today. As always, let me know what you think. Subscribe, like, and comment down below on this YouTube video. Follow me on Twitter for more content, and remember to like and retweet tonight's Market Outlook tweet there, pinned to the top of my timeline. And if you haven't already, join the Market Outlook community on Facebook. As always, thanks again, everybody. Have a great evening, and we'll see you all tomorrow.